Advantage with Kathleen Hayes and Bonnie Quinn on Bloomberg Radio.
Taking a look now at what happened in 2014. A lot of big surprises. Who, for example, in January of this year would have said, by the end of the year, crude oil prices are going to be 50% lower. Hardly anyone out there. It's causing a lot of dislocations in the economy, certainly in the energy industry. We want to open our window a little bit broadly, or more broadly, I should say, to that question with our next guest and ask what does it mean for 2015? Joining us now, David Edwards, President, Heron Financial Group. He is a wealth manager, an investment advisor, over 100 and some clients. Also, I'd like to add that Dave got his start working on Wall Street at the likes of J.P. Morgan, Nomura, and Morgan Stanley. So welcome back.
Hey, good morning.
Thank you for joining us in studio. So let's start with what surprised you, what surprised all of us in 2014?
So many people like to look at their predictions for the start of the year and point out how clever they were. And I like to look at the things that nobody predicted. There's always going to be events that occurred outside of our expectations, and sometimes they're good for us and sometimes they're bad for us. But that process keeps you humble. And it also gets you thinking about what might happen next year. So there's about 6 things that nobody really forecast for 2014. The first thing was the dollar soaring. We've had a long expectation the dollar would be falling. We've got deficits. Our interest rates are low. Money should naturally flow away from the U.S. to other currencies. And all of a sudden in June, it took off 12%. Really? And what that did was it knocked any international returns from positive to negative. Really? And we first noticed this looking at our clients' portfolios. All of a sudden, they were slumping dramatically relative to the S&P. Well, nobody forecasted that U.S. large caps would be the best place to be for 2014, and nobody forecast that small caps would do quite poorly. So that was interesting.
Okay. What, number 2?
Yep. Nobody forecast that utility stocks would be the best performing sector for 2014. Nobody forecast that crude oil would collapse 50%, gold would fall 37% from the high, commodities in general would be down sharply, and nobody forecast that the 10-year would fall from 3% to 2.2.
Oh, no, wait, that's not true. That's not true. There were people who thought that we were going to, I think when you looked at a lot of economists and a lot of chief investment officers, the people looking more broadly, they were looking for bond yields to rise. But I think if you talk to a bond trader in Chicago, as we did at the beginning of the year, we had a number of people who said, no, they were not going higher on yields.
So you talk to cleverer people than me. But you add these all together, and what you would normally forecast is that the U.S. economy is heading into a recession.
Right.
Okay, but we have a whole bunch of economic data that says the U.S. economy, in fact, is finally back to highway speed. We had a very nice GDP report, 5% most recent quarter, running about 3% year over year right now. That's a pretty good number. Unemployment at 5.8%, the lowest level since George Bush created the economy. Housing prices a long way from the peak, but 30% off the low. U.S. Christmas sales up 5.4%. That's a big number, buoyed by consumer confidence.
So wait, David, is your point that the people that were forecasting the wrong things at the beginning of the year were also forecasting that the economy was slower than it is, and none of that materialized, so it's great?
Well, our forecast was that the economy was going to finally get into fourth gear this year, and we see that, so we feel good about that. We did not expect that large cap stocks would do so well. And we actually jumped into that to find out, well, why? What do we don't understand? And there was 2 stocks that made all the difference. One was Apple, and the other was Microsoft. So this year, most mutual fund managers are doing quite poorly because if they underweighted Apple because they think it's expensive, and they underweighted Microsoft because they think that company is the General Motors of software companies, they didn't even touch the S&P. And then if you were in the small cap universe, which only went up about 2 to 5% depending on where you were, you did even worse. So it helps to do that analysis to find out where our research, went wrong to help us be better for next year. So there's 2 ways of looking at this data. One is to say, well, by all historical measures, we should be heading into a recession right now. But in fact, we see that there's a lot of good going on in the U.S. economy. So what does that mean for next year? Well, if you look at the European economy, that's entering its 6th year of recession. And the situation has been made worse by the Russia situation. The Russians took the goodwill they engendered in Sochi and immediately squandered it by invading Crimea. And as a result, that's the worst performing stock market of the year, down 45% in dollar terms. China also. China, according to the IMF, is now the world's largest economy. Really? Well, let's break down the numbers. If you use the IMF numbers, purchasing power parity, it's about even with the U.S. On the other hand, if you look at other measures, maybe it's a third less, particularly because Chinese numbers aren't very good. Another way of looking at it is GDP per capita. It's about 20% of the U.S.
Yeah. So what's the point of all this?
So the point of it is that there's a difference between income of a country and wealth.
Okay.
China, you cannot disrespect them. They're definitely on the move. They've gotten to the point of 1950 in the United States.
Okay.
They're going from a manufacturing economy to a services economy to a domestic consumption economy. They've got a long way to go. The Japanese tried to do this in the 1980s, did not make it. They're still stuck in a 20-year recession. So what does it mean for investors? So what it means for investors is that large cap stocks probably will underperform next year.
Okay.
Small cap stocks will probably perform better. Commodities will probably do really well. It's been 2 negative years in the commodity markets.
Uh-huh.
Really? Now, the price of oil,
what?
it's 55.
Why would that mean that next year they'll do well and that suddenly...
So the price of oil hit $55 a barrel this week. It's down 50% from June. All of the shale operations that are in the U.S. that are contributing to the current global glut of oil really only make money at $60 or $70 a barrel. So when those current rigs run out in the next year or so, there won't be a rush to put new rigs to work. And we see it in the drillers, down 80% on the year.
Well, go ahead, Bonnie.
Well, I was just going to say, is most of your analysis then sort of quant-based and model-based, or are you looking at fundamentals or macro?
There's the macro and the micro. We love to talk about the mosaic theory of investing. We're looking at 30,000 data points over the last 6 months and trying to forecast 10,000 data points for the next 3 months, next 6 months. And we never react to a single data point. For example, the Case-Shiller housing numbers today. We look at a data point like that as a tile in a mosaic, and we put 30,000 up on the wall, we start to see a picture. So that picture that we have right now is kind of a cautious picture, a yellow picture. The easy money was made in the last 2 years. I didn't even think the stock market was going to do this well. My forecast was 8%. It's actually 15%.
Well, in fact, now a number of people are saying because of the gains of the last few years, valuations are stretched.
Yep.
And the Fed is probably going to make some kind of a move, and therefore you may not have much gains at all unless there's some positive upside surprise next year. What's your view?
Yeah. So where's the positive surprise going to come from? 2 things happen. 1, the U.S. resumes its traditional role as the locomotive of the world economy and drags the Europeans and the emerging markets along with it. Or 2, we get dragged back down to the level of the Europeans. Now, my bet is that the U.S. drags the rest of the world along with it. Europe is a basket case. I don't know. They have no political will to address their fundamental economic flaws. Once upon a time, Italy was the world's manufacturer of jewelry, clothing, leather goods, and now that's all made in China. So what are the Italians going to do? But other parts of the world certainly want to keep enjoying this consumer shift from subsistence living to middle-class living. And those middle-class consumers, billions strong, want iPhones and refrigerators and cars. And so for the most part, we're gonna get along, but it's always something. You always have to be thoughtful.
All right, we're going to continue this conversation. Heron Financial's David Edwards is with us. We're going to ask him what exactly he's doing in terms of switching around his positioning. All of that is coming up, and just had me thinking there, and I took a look at the S&P 500. The best performer this year so far. Do you want to have a guess, Kathleen?
Okay, tell me.
So no guess then. Southwest Airlines, 126% of a gain.
Love.
All right, we're going to be back with David Edwards. This is Bloomberg Radio.
You're listening to the Bloomberg Advantage with Kathleen Hayes and Bonnie Quinn on Bloomberg Radio.
Welcome back. We're speaking with David Edwards of Heron Financial. So, David, continue with what you were saying. What would we position for then in 2015? Where would you be putting your money to work?
So I'm more interested in small cap stocks. I'm more interested in international stocks, and I'm more interested in commodities. And we actually took a look at our commodities positions, which we do through a single PIMCO fund, and realized we were down 20 or 30% in certain client accounts. And we sold it all yesterday, capture the tax loss, but we'll put the money right back in on January 30th.
Into those same commodities?
Exact same commodities.
So grains or energy or? So
it's a PIMCO broadly based fund. Mm-hmm. It has metals, it has industrial commodities, iron, copper. It also has grains, pork bellies, all the good stuff.
Why do you like these commodities?
We know that the long-term demand for commodities is up. because there are 7 billion consumers, eventually become 8 billion by the end of the century, and they're all living in bigger houses with more materials, and you need raw materials for that. And there's only so much supply that you can create. And then you have short-term oversupplies, as we see right now in the oil markets, but the long-term trend is up. So we always have 5% there, and if it becomes too high, we scale it back. If it falls too low, we add to it.
Okay, 5% in commodities. You didn't do so well this year, but you're going to take your loss, boom, get the tax advantage, move on. Small cap stocks. Why do you like small caps?
Small cap stocks did very well in 2013, got ahead of themselves, did poorly in 2014, just kind of backing and filling. If you believed that the economy was heading into recession next year, then you would shy away from small cap stocks. But I don't believe we're going to be in that case. I believe we'll continue this nice 3.5% low inflation, low yield environment. I think plenty of small cap companies are going to do just fine.
And why international stocks? You just mentioned how the strong dollar surprised people and reduced their returns if they were invested in certain big international stocks. Why do you like them now?
Yeah. Again, we don't pick individual securities in that element. We use index funds to cover that exposure. Generally speaking, we have 10% in developed markets, Europe, Australia, Japan, 5% in emerging markets, Brazil, India, China, Russia. And when they do poorly, we add. And when they do well, we subtract. And then this asset allocation gets us those nice long returns, which for the last 20 years have been about 9% a year.
How about cybersecurity and cyber attacks? We know Sony has to worry about it. We know all kinds of big companies, banks, but Heron Financial has to worry about it too.
We had more attacks against our clients in this past year than the previous 20 years. And the kind of attacks we had were people having their email hacked by using a Starbucks Wi-Fi. And you get an email from a client, Dave, I'm in Spain. I can buy this foreclosed condominium. Can you send $200 million to Barcelona? $200,000 to Barcelona? Jennifer, are you in Barcelona? No. Change your passwords. We've had social engineering where hackers scan people's Facebook accounts. Grandma, this is Sophie. I've been in a traffic accident. Listen, I need $2,000 real quick or I'll be arrested. And in 2 separate cases, it must have been the same script. The women went to Western Union, and Western Union refused to process the wire. It was totally bogus. Phishing attacks. I got a very legitimate email from ADP the other day, which I would have clicked on, except we use Paychex at my firm, not ADP. Elder abuse. This is really serious. One of our clients was on vacation and learned to his sadness that his father had died, and he hustled back from vacation. And in transit, he learned that 6 months ago, the father's chauffeur had drafted all new legal documents naming himself power of attorney, executor, and sole beneficiary of a $3 million estate.
You're kidding.
And a law firm conspired to create 100% legal documents, and we have no recourse. And the learning from that is that... How
is there no recourse? Did the dying man sign the papers?
It's signed and witnessed. And there's nothing we can do about it. And the warning to baby boomers that have older parents is that caregivers are often very seductive when somebody's in their 80s or 90s. Oh, your son, he doesn't visit anymore, but I'm here every day. Take care of me. Why don't you take care of me? And that's what happened in this case. And the client may not be able to can't get access to the family home, may not be able to get access to the family photo albums. And an elder abuse attorney we talked to told us this is a very common event. So if you're a boomer with an aging parent, you have to be very proactive and make sure that you get the stocks out of the safe deposit box and into a brokerage account.
Or visit your parents more.
And visit your parents more.
Be proactive that way as well.
In fact, this gentleman was very hostile towards his son in the last 6 months of his life, and the son backed away. And it was because the chauffeur had seduced the father, saying, your son is a bad son. He doesn't love you. I love you more. So we are, of course, terrified that this kind of bad thing would happen to our clients. The father, unfortunately, was not my client.
Okay, so what did you do? What should you do?
So we engaged a cybersecurity firm over the summer, and we said, look, we don't have unlimited resources or time. Give us a priority list of things that we need to fix within our firm, and what do we need to tell our clients? And so on that basis, we did a complete review of all the systems.
We have about 30 seconds left, so give us a list of those things people should know about.
Number one, examine where you have important data. And your bank accounts should have one password. Your Staples account should have a different password. You should use LifeLock. You should use CSID. You should definitely look at your statements. You should definitely look for strange items on your credit card. But you should not be paranoid. Just be vigilant. 11 million people have their identity stolen every year, but with a couple of modest efforts, you can avoid being the low-hanging fruit.
Wow. Boy, oh boy.
As if investing wasn't hard enough. Now you have to worry about everything else as well.
Well, David, thank you so very much for joining us today.
Pleasure, and Happy New Year.
Happy New Year to you, too. We'll look forward to having you back soon in 2015, and certainly we'll talk again about how to protect ourselves, not just from cyber attacks, but from evil people who would prey on elders.